Conference call of Craftsman Automation Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand the conference over to Mr. Srinivasan Ravi, Chairman and Managing Director from Craftsman Automation Limited. Thank you, and over to you, Mr. Ravi.
Good afternoon, everybody, and thanks for joining the earnings call today. This time around, I would like to run through the changes which has happened in the last quarter, which is quite substantial. So I will take 10-15 minutes to highlight the changes and what is the ongoing projects and the status of the acquisitions. The strategic investment, what we have also announced at Hosur, also I'd like to highlight at the end of the first introduction. Investments made during the current year was 1,015 crore, mainly for DR Axion, 24% stake, the balance, which is 250 crore. Sunbeam investment was 606 crore as OCD. Some of it will come back when the land sale happens. Craftsman Germany, 154 crores, that is 94 crores for acquisition and 60 crores towards working capital requirement, which is very strategic. CapEx investments in greenfield projects, CapEx has been 700 crore for the current period, including greenfield at Bhiwadi at 219 crores, excluding land, because land is also a little common because we plan to house Sunbeam also when we shift the Gurgaon plant. Kodavadi is 91 crore. The status of the project, Sunbeam has become a wholly owned subsidiary from 9th October and achieved a turnover of 284 crores with a positive EBITDA of 10 crore. As planned, shifting of Gurgaon plant has already started and hope to be completed by Q1 of FY26, after which we will start looking at the land sale of Gurgaon. 50% of the employees have opted for VRS and we relieved them in November 24. So balance, once the shifting is started, that is in April, May, we will be settling the balance for the VRS. The order book status is comfortable and hope to achieve a reasonable turnover and positive EBITDA in Q4. Craftsman Germany has a consolidated revenue of 56 crore with a positive EBITDA and hope to continue positive results in Q4. The order book for Craftsman Germany is for the calendar year of 25 is full. Bhiwadi commenced its operation in 31 August, and you may know very well this is the first foray into structural parts, especially the alloy wheel, which is for the BIS initiated change in the country. So we had a timeline which for the festive season, so we had to put in all together. So for a small turnover of 38 crore, we had to spend a lot of money during the startup period. So we have brought the plant into production in a record time, that is from the land acquired in January of 24. We started commercial production in August. So because of this, there has been additional costs which were involved there. But the plant is now operating at 20% efficiency and will be 25% of the capacity and will be up to full speed by July of this year. Kodavadi has supplied several samples to customers waiting for approval, and we may start production in Q4 of FY26. FY25. The new greenfield projects at Hosur has been planned to set up the alloy wheel plant in complementary with the Bhiwadi alloy wheel plant to supply to customers in the south. So both the plants have been fully booked for orders for the alloy wheel, one in Bhiwadi as well as for Hosur. Consolidated EBITDA for the period has been 609 crores against the previous year 9 months EBITDA of 684 crore for various reasons of many startup projects and also massive expansion and the expenses related to the massive expansion, which we have created the extra overheads to look at the forward-looking year. The EBITDA contribution is from the powertrain is 298 crore, aluminum products is 315, and industrial engineering is 36 crore, unallocated is 40 crore. The shortfall is mainly due to the expenses like acquisition costs, related due diligence, legal and other initial operating losses at Bhiwadi and Kodavadi. Now I'd like to run through the changes in the structure of the organization a little and also the change of in each of the segments as we go on. In the powertrain, at the IPO time, we were heavily dependent on the commercial vehicle segment, and we are looking forward towards more and more clients, mainly the multinational companies, setting up plants here for their starting of the diesel engine production in India, with the view for the Indian market as well as for the global market, which is still ongoing, and we have received the orders. At the same time, the ramp-up has not happened. These are orders which will fructify in the coming couple of years, translating into revenue and profitability. Meanwhile, we have also embarked on a long lead time project for the stationary engines, which we had declared to the shareholders and made them sensitive towards the long-term nature of this sort of investment, because it's an exclusive club for the stationary engines. Hardly 10 companies in the world are ruling the market for the stationary engines worldwide, and there is a big inflection point which has happened due to the data centers growth, mainly driven by AI. So this was also highlighted in my chairman's speech during the annual report, which you might have read. So I'm proud to say and happy to share with the shareholders that we have got at least 5 engagements of the top 10 of the companies in a big way. We have received orders. It is already ongoing. The machining process of the trials have started at our Unit 3 facility, and we have started tooling development to be for the production at Kodavadi plant. Since these nature of these projects are long gestation for development, that is, the development period is 18 to 24 months, and the customer validation is almost a year. So we are almost halfway through the journey, and next 1 year later, we will see the revenues flowing into the stream. We got our foot into this business at the right time overall, and we are looking at a revenue of $100 million in 4 years' time, only in the powertrain division, contributing in the contribution coming from the stationary engines, mainly from the power generation. Now, coming to the aluminum segment of the business, when we went for the IPO, we were only in the two-wheeler business, only in the ICE portion of the two-wheeler business, with a small marginal presence on the four-wheeler business. Now, what we have transformed in the last year was, after DR Axion acquisition, we have become predominantly on the four-wheeler segment of the business. So dependence on two-wheeler came down, and with the latest initiative into the one thing is Sunbeam acquisition, we have spread ourselves geographically very well, and also the clientele of Craftsman and DR Axion, the overlap has been negligible, and also there is practically no overlap between the clientele of Sunbeam and Craftsman, and the process is also more or less not overlapping exactly. So, but the strength of each of the companies is helping the Craftsman to leverage on this strength. For example, the Bhiwadi plant for the alloy wheel has been set thanks to the DR Axion acquisition, where it is clear that without that, the plant would not have come up in a record time of 8 months, which has never been done in this country so far. So now, with this sort of an execution strategy, we got the second chance at Hosur now for the customers in South. The next is with this alloy wheel, which is also today the structural part in the two-wheeler. Our dependence on ICE for the two-wheeler also has dramatically come down. Still on the consolidated, not the consolidated, I think the segment-wise end use of the aluminum products, it is predominantly four-wheeler with the marquee names in the both in the domestic as well as the export customer range. And after this acquisition, we have reached a possible 4,000 crore revenue in the aluminum business in the next financial year, which is still suboptimum in compared to the global majors, which I had highlighted in the past, that we are not able to serve the global customers because of the size of the aluminum segment of the business. But at 500 million or 4,000 crore approximately, I think we are attracting a lot of attention globally for also export business. Now, coming to the industrial engineering segment of the business, we have done quite well on the automated storage business, and today our automated storage business is contributing to a very high percentage of the storage business, and the order book is for the next year on the automated storage business is quite full. So we will reap the benefit of profitability going forward on the storage business. Never we have given any guidance, but now that there has been a massive shift in the company's revenue growth and the acquisition, so we need to look at the consolidated numbers of Craftsman going forward. Just to give a thumbs up on a guideline, which normally we never give, this is only a guideline. We are looking at an consolidated revenue going from mid 5,500 crores in the region to going to around 7,000 crore in the next financial year. This is not exactly apple to apple because some of the acquisitions has happened in the second half of this year. And the EBITDA consolidated number from say around 850 crore range should go up to northwards of 1,100 crore, which is almost a 29% growth in the EBITDA numbers, which will lead to a 40% growth in the EBIT numbers, say from 500 to 700 crore in the coming year. So this is the projected revenue of the company, which is for this massive expansion. This is the reason when we also have informed the shareholders when we went for QIP. This is a one-time QIP which we have raised. In the history of the company, we had raised 150 crore in 2010-12 from private equity, and during the IPO, we had raised only 150 crore. So 300 crore has been the cumulative infusion as capital into the company. Otherwise, the company has been organically growing. With the massive QIP infusion of 1,200 crore, we have executed the multi-pronged strategy to take the company to greater heights. So we have developed the escape velocity to reach to the next level of the organization growth. So now there has been always when we are putting up the expenses slightly ahead of the project, none of the projects are risky projects in my opinion, totally overall. But I think the 95% investment has gone into organic or acquisitions within the country, and hardly 150 crore has left the shores of India into outside a subsidiary, which is very, very strategic and which is helping the growth in the stationary engines. So we are very comfortable as Craftsman to be at a very low level of debt, but as I had mentioned earlier, for a short period of time, we don't mind exceeding the debt to EBITDA levels. So we are looking at a consolidated debt to EBITDA for this financial year as 2.24, which would have looked at 1.88 if the land sale of Gurgaon, which will fetch around 300 crore plus, had happened in this financial year, but is not going to happen. Otherwise, it would have been 1.88. So anyway, we are very hopeful and quite confident that we'll be able to sell the land in the next financial year. With that, we expect the consolidated debt to EBITDA to be around 1.4 in the next financial year. So going forward, in spite of the capex which is being done. So this is the headline which I would like to reiterate before I open the floor for question and answers.
So shall we start with the Q&A?
Yes.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets and even restrict their question to 2 per participant. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Mumuksh Maldesia from Anand Rathi Institutional Equities. Please go ahead.
Yeah, thank you so much, sir, for the opportunity. So firstly, just on the standalone margins, which has come down sequentially, any reason for that segment margins to come down, sir? Any one-off there, sir?
Yes, on the powertrain segment, we have built up capacity. So far, we are making only truck engines. We have built up machining capacity and other capabilities for handling large engine blocks or V12, V16, V20 that is weighing in tons. That is, the machining technology is more or less same, but the equipments are totally different. So we have added more infrastructure plus machinery, plant and machinery, and started doing the trial production. So all those expenses have been booked in the powertrain segment. The powertrain segment by itself has not increased on the value addition. And we also have invested for the TRIM 5, for the construction equipment, for the engine emission norm change. And the new projects, whatever is there, we have set up some lines for export of, not direct export, our customers, multinational customers are exporting. So it is under trial production again. So we have made all the investments required and incurred the expenses as well as some overheads and people cost towards the growth. This is one of the reasons we are now looking at big growth going forward in the coming years. Powertrain will be little delayed on the growth. Maybe 1 year later is more on the FY27 number. FY26 we'll see some portion of it. But I think the investments, as I mentioned, is a long gestation. That is the reason. And any increase in depreciation and the stationary number which is there on the value addition portion of it will directly hit the EBIT. So that is the reason. It's not anything of the organic performance or the execution portion of the company. I hope I answered that in total.
Got it, sir. Generally, I mean, all this efforts, sir, I mean, any quantification you want to give, what kind of impact this quarter it would be? And I mean, once all thing normalizes, I mean, say in FY27, any guidance you want to share on the margins for the powertrain segment, sir?
Yes, I have been guided as a company on FY26 overall, which I think the margins will swing back to the original margins in 2 years' time on the powertrain in the two phases because of the massive expansion.
Got it, sir. So on this, on the employee cost saving for this the new acquisition, Sunbeam and the plant closure, any number you want to share? What kind of benefit it would bring on the EBIT margin, sir?
You're talking about Sunbeam standalone or a consolidated number?
Sunbeam numbers, sir. Where basically we have given the reduced the employees and whether close the Gurgaon plant, right, sir?
We not yet closed it. See, we are on the process of closing it, but I think we announced and we've taken the board approval. It has to go for shareholder approval soon for selling the land of Gurgaon, which is valued on around 300 crore as a number approximately. So with which will you are asking for the number of plants today?
Yeah, reduction in employee. Yeah, reduction in employee cost and because the plant being closed, any saving from that also?
Yes, 5 plants will become 4 plants in one sense or another totally. But I think that the one plant will be the same location as Craftsman's current Bhiwadi plant, which will be shifted to there. Yes, the employee cost is going to come down by at least 30% minimum. And further, we need to improve the operations and process to bring down the employee cost further. Employee headcount further. Employee cost will be per head will be increasing as we move on. But I think the employee headcount will continuously reduce in the next 2 years.
Got it, sir. So can you share what the capex 9 month has been, and what is the full year guidance, and also for next year, if you can share the capex guidance?
This is looking at standalone Craftsman. It is the
yeah. If you can have console number also, it's fine, sir.
Console number, I do not have it ready-made available today for next year on this matter because we are contemplating for Sunbeam whether we need to modernize quickly or modernize slowly. It's a decision to be taken. So we are looking at 700 crore until now, the capex done at Craftsman, and maybe another 150 for the quarter, so around 850 crore for this year. Next year, I think it should be less than half the number, including the maintenance capex.
Got it, sir. And just lastly...
Interrupt you, sir,
sure.
But may I request you to please rejoin the queue? We have participants waiting for their turn. Thank you. Ladies and gentlemen, we will request you to kindly limit your questions to 2 per participant. The next question is from the line of Jinesh Gandhi from Ambit Capital. Please go ahead.
Yeah, hi. My question is on, in this quarter, we had multiple different impacts on the performance. So if you can highlight the exact impact of Sunbeam acquisition on the aluminum consolidated margin, what was the impact of that? And when on the standalone powertrain business, you talked about several costs coming in, and standalone aluminum also had Bhiwadi plant impact. So if you can talk about the impact of this the transitory costs which are there in P&L that will make it easier for us to understand?
Sunbeam was EBITDA positive in the Q3, but at the EBIT level, and it is negative totally, and so that would have around 9 crore, minus 9 crore at the Sunbeam level. And for the Bhiwadi plant, I think it is quite substantial because of the startup cost. It is around 20 crore is the negative EBIT at Bhiwadi. So both put together, we can say around close to 30 crore was impacted only in the Q3 on the aluminum segment of the business.
Okay. And similarly for the powertrain, given there was so much of investment on the stationary engine as well as strengthening on what it would be?
Overall, I think 50% has come from the stationary engines, whatever the development we are doing, and half of it has come from the new lines and capacities we set up for various customers, which the production has not either it is a startup production or is not yet ramped up. So overall, I think it's a 50-50 for the cost, because we have many plants for the powertrain now totally.
Okay. But any sense on combined cost for that? What would be it?
You are talking about cost. One is the inflation of people cost. The absolute value addition has not gone up, or the revenue has not seen the growth. So there is an inflationary pressure. So I would say 25% or 30% is inflationary pressure because of no growth. Balance 60-80% is because of the new projects, both on the station engines as well as on the new lines.
Okay, got it. Secondly, when we look at the derived DRN revenues, it's showing about 20% decline on YY basis for 3Q. Is that observation right? And if yes, what is led to that?
There is no revenue decline from DRX you're talking about, no?
Yeah, I'm taking the 38% revenue contribution from in the aluminum console as DRA revenues and then comparing it with last year, so it's showing about 20%. Maybe that derivation is not the right thing.
Clear, and your question is not audible, and I need to understand the question, please.
Sorry, so DRA business, how was the growth in the DRA business?
There's no growth in the DRA business. It is intact. I think it has been very stable because it is directly linked to only to 3 customers, and it is on public domain, the customer's growth in the passenger vehicle or degrowth.
Right. Okay, I got that. And lastly, what would be our consolidated net debt now, and what should be the full interest cost, say, by 1Q as some of these projects get commercialized?
Yes, I had mentioned the consolidated net debt for this projected for this financial year. No, I'm looking at the projected number for this financial year as a consolidated net debt. We are looking at around 850 crore. Sorry, the 1,900 crore as a consolidated debt. So, okay, that is the debt to EBITDA will be 2.24, which I read out. And if the land sale had happened, it would have been 1,600, but it's not happening this year. In financial year, it would have been 1.88 the debt to EBITDA.
Sure. And what will be your cost of debt?
Pardon?
What will be your cost of debt for the 1,800 crore?
No, this is a normal debt we have got. I think is nothing different from the market trend. I would say it will appear on the numbers. I think it can be taken offline.
9-10%. Got it. Thanks, I saw that.
Plus minus.
Okay. Thanks. I'll go back and check some more questions. Thank you.
Okay.
Thank you. The next question is from the line of Abhishek Jain from Alpha Accurate Advisors Private Limited. Please go ahead.
Thanks for the opportunity and congrats for the precise set of numbers despite the lot of the challenges. In this quarter, we have seen a significant growth on numbers like other expenditure and employee costs. So if you can throw some light, what is the extraordinary expenditure in this quarter or one-off in the console year?
There are 3 components to it. One component is we have looked at what is the requirement for next year and started taking people, employees, and training it. That is one long-term objective. Short-term objective is how to manage the Sunbeam acquisition and the two greenfield facilities of Craftsman, one at Kodavadi and one at Bhiwadi. So there has been expenses occurring and people cost incurred even before the start of the production. So these are the two major components. The third major component is the normal inflation, which is happening for the people cost, which we have been always talking about, and we are more inclined towards semi-automation and improvements of processes to not to increase the headcount, which is inflationary.
So, is there any legal and consultant charges in this quarter because of the acquisition of the three companies in other expenditures?
Yes, that is there because we have acquired, there is a Sunbeam related expenditure at Craftsman, there is also DRX related expenditure. Also for Kronberg, Germany, there is an expenditure. These are all one-time expenditures, yes.
And how much is this, sir? Because there is a significant jump in the number.
Now, getting that into detail will be time consuming. If you don't mind, you can come back at the end of the Q&A so that we will give a fair chance to everybody, if you don't mind.
Okay, sir. And my last question on the powertrain business, basically business can be categorized in the three parts. So one is the standalone, another is the Craftsman Germany, and third one is the Kothavadi. So how do you see scale up in all three business, and how would be the margin profile in FY26?
Sir, I didn't understand the question, and the voice clarity is a little poor. I think one question, if you ask at a time, I think is better. I think, please, can you repeat?
Sir, just wanted to understand the scale on the Germany business and Kothavadi.
Germany business is not scalable to that level. Maybe 5-10% we can grow because it is a fixed plant, and we are expecting to increase revenue by 10%. That's what we are looking at. But we are getting a strategic advantage that the same team is working for us for development of products in India. Even now, as we speak, the teams of Craftsman and Kronberg are together at a customer place in Europe for discussions for a project to be brought to India. So this is the advantage. One good thing is this company has got marquee customers. I think there are three good engine customers for that, and they have decades and decades of experience there, people knowledgeable. So this is giving a lot of trust to the customer, and they are giving business to either Kronberg or to Craftsman, as the case may be, wherever it's suitable. So we've been able to acquire quite a substantial business in the last few months after the Kronberg acquisition.
Okay, sir. And sir, is there any date repayment plan from FY26-27?
Pardon, sir? Sorry?
Any as a total borrowing is around 1,800 crores. So what is your date repayment plan?
No, can you, without the speaker, can you come, because I think it is voice is a problem.
Hello? Are you able to hear me?
Now I am able to hear you, yes.
Yeah. Sir, the total debt is now 1,800 crores, and so just wanted to understand what is your debt repayment plan for the coming year?
No, the debt has been taken recently. The debt has been spread over, I think, 5 to 6 years, right? It will be more or less linear, I would say. But as I mentioned, the debt will be coming down in the next year in one big chunk when the the Gurugram plant is getting sold, which is quite substantial, is a 300 crore. And next year, with the capex being lower on the consolidated balance sheet itself, the debt is likely to come down. So I had shared the debt numbers when I read out the debt numbers. I can read it again now.
Okay, sir.
So we are expecting the debt to come down next year to 1,400 crore on the consolidated level.
Okay, sir. Thank you, sir. That's all from my side.
Thank you.
Thank you. Participants are requested to kindly use handsets while asking a question. The next question is from the line of Joseph George from IIFL Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. I have two questions. One is, you mentioned that Sunbeam had a negative EBIT, and similarly, the Bhiwadi plant was also below EBIT break-even. So when we think about, say, FY26, would it be fair to assume that on a full year basis, Sunbeam would be at least EBIT neutral in FY26? And similarly, when do you expect Bhiwadi plant to become EBIT neutral?
The Bhiwadi plant will be a bit neutral starting from Q1 of FY26. And the Sunbeam will be, the Bhiwadi plant will be a bit positive, high single digit by end of FY26 totally. And Sunbeam by itself will be a bit positive by Q2 of next financial year, FY26. And for the full year, it will be a bit positive.
Understood, sir. And the second question that I had was in relation to your aluminium segment. So when I look at the aluminium segment EBIT at the consolidated level, it is about 72 crores of EBIT. And at the standalone level, it's about 20 crores of EBIT. So which means that the subsidiaries have a positive EBIT contribution of about 52 crores. Now, the EBIT for Sunbeam is -9, as you mentioned, which means that the residue is about 61 crores of positive EBIT. Is that entirely DR Axion, or is there any other element there?
See, the most of the Craftsman's own EBIT has been more or less been wiped out because of two reasons. Because of the mainly because of the Bhiwadi project, I would say, in total on this.
So actually, I'm sorry to interrupt. My question is more on what is the EBIT in each of the subsidiaries. So consol is 72 for the aluminium segment. For consolidated aluminium segment EBIT is 72. Standalone aluminium segment EBIT is 20. The remaining is 52. I wanted to get the breakdown of that 52.
So I think I will request somebody from my side to answer this, please.
Joseph, actually, this is the balance is the intergroup adjustment, which has happened because of the that has been in the standalone. It has been categorized as others segment because some trading was happened between the groups. That is the thing, and so these are it's only an intergroup adjustment, which we'll explain later.
Understood, sir. No problem. Thank you.
Thank you. The next question is from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
Yes, sir. Yes, sir. Thank you for the opportunity. My question is on the alloy wheels to begin with. So, what would we will have once the Hosur plant is ready, and by when would that capacity come in, sir?
Hosur plant will be operational by Q2 of next financial year, and Q4 of next financial year it will be fully at full capacity.
So,
okay. The capacity of each of these plants are around 400 crore plus. Bhiwadi alloy wheel and the Hosur alloy wheel plant, both put together, the peak capacity which we expect in FY27 will be between the two plants 800 crore on the alloy wheel.
Sorry, so how much is that capacity?
Sorry to interrupt, Mr. Saraf. We are unable to hear you clearly, sir.
Is it better now?
Yes. Can you please switch on to the handset mode?
Yeah, I am on the handset mode. Sorry, so could you just repeat the capacity number?
We talked about in FY27, each of the plants, Bhiwadi alloy wheel and Hosur alloy wheel, which each will contribute more than 400 crore on the top line.
Okay, top line. Okay, got it. And secondly, on the Kothavadi plant, you did mention that the stationary engines will start next year, but we'll start with some production in the next quarter itself. So is that the wing?
No, sorry. It is the toolings itself, as I mentioned, the plant is just constructed and the trial production. The toolings are getting ready in Germany. The toolings itself will be delivered only in the end of next year. So we will not see revenue from the industrial engine portion, but we are doing some engineering parts on that. Kothavadi plant is also going to serve that. So there will be some revenue from the Kothavadi plant, but not from the powertrain perspective.
Right. Right. So, any kind of sense on how big could that business be, ex of the industrial engines from Kothavadi plant?
The Kothavadi plant and the machining capacity which we have put up in or in the process of putting up at Arasur plant in Unit 3 in Coimbatore. On the stationary engines, we are looking at around FY28, 29 in that range. We are looking at around $100 million, around 800 crore revenue, 850 crore revenue, which I had mentioned in my opening remarks, which will add to the powertrain, which will be quite significant.
Right. No, so in this next 1 year, excluding the before you start the stationary engine is what I was asking. This engineering that you were saying that you will start some kind of revenues will start from the Kothavadi plant. How much could that be?
That should be around 150 crores for the full next financial year, because most of the trial run, it's a greenfield facility. And the first time we are getting the cast iron foundry, so it will be a little slow start only.
Got that, sir. Got that. Thank you so much. I'll get back to you.
Okay.
Thank you. The next question is from the line of Ganesh Ram from Unifi Capital. Please go ahead.
So, thank you for taking my question. Now, my questions are more on the long-term strategy that you're adopting. So I'll have two of them, please. The first one is just on the Frauenberg acquisition and this move into stationary engines, right? So there's obviously a long gestation period, 18 to 24 months of development, 1 year for approval, right? So what are sort of the risks that we have to be conscious of when you go through such a long development process? And overall, what gives you the confidence that there will be acceptability of the product at the end of this journey, right? How are we placed versus competitors, and what's the edge that we are bringing to these OEMs? That's the first question, sir.
Okay, thank you for the question. I will answer the question first.
May I request the participant to please mute your line, sir? There is a disturbance coming from your end.
Yeah. So I'll just do that.
Yeah. On the powertrain, in the past history, all the stakeholders know that we do not have a cast iron foundry on the powertrain. We are partnered with one of the leading foundries for the smaller castings 20 years ago, and as prior to when the relation goes strong for exports to mainly commercial vehicle segment in North America. It has been going on for more than 2 decades now. The second tie-up we made was a leading axle casting manufacturer, again another listed company, which is there, and this has been almost a decade now, and their exports have grown, and we are tied to them. For the other engine blocks, the leading foundry in India, where we have been partnering ever since we took the Daimler business in 2008, 2009, and we have been partnering with them for, I think, around 8-10 projects for the powertrain. So we are well covered with this partnership going on very well. So we have not infringed any of these customers by backward integrating anywhere, and our relationship remains strong, and we have opened a new avenue on the station engines, which was not available for the Indian market or the global market, because most of the multinationals are even today doing in-house overall, and the outsourcing has been negligible because of the difficulty in technology, both on the casting and machining, and the number of casting players also in the whole world, including China, including the OEMs themselves, hardly 10 players are there, and standalone machining companies who are doing to this criticality, maybe 3-4 in the whole world, totally, overall. So we as a machining company it is for us a normal migration. It is a challenge, but it has gone through already. We have submitted samples that's got approved. On the casting side, with Frauenberg acquisition, we don't see any risk there because the technology is already in-house there. So only the gestation period is there to develop this. Otherwise, the customer themselves will not be placing order. Now, you may say customer approval may not come, but customer skin in the game is very high. All the pattern, tooling equipment which is running, one block, I think it is costing millions of dollars for the tooling cost which customer pays for. So no customer is going to just like that select a supplier, and a lot of engineering costs they will incur while during the development stage itself overall. So it is a very, very strategic relationship. It is a very, very sticky business. So we will be through with that.
Thank you, sir. So that's clear. Another question that I had is, with all the consolidation and the activity that you've undertaken, what would sort of be, how should we think about your exposure to ICE from a product portfolio point of view? And how will that evolve over the coming years, right? So for each of the segments, how would we be exposed to ICE? And how do we sort of de-risk that over the coming years? And would it be possible to sort of maintain these margins or improve them as we go forward through that process as well? I think you'll be in a better position with the granularity and nuances of that, but the broad understanding I'm trying to develop is on those two elements.
On powertrain, sorry, please mute it. Please mute.
Yeah.
For the powertrain, 100% of it is ICE related. I would say 90% is ICE related. Some are transmission parts which can be neutral, whether it's ICE or not. But these are not, I think the passenger vehicle segment on the powertrain is negligible, totally, overall. Hardly 5% or 10%. Balance is all related to commercial vehicle, construction equipment, and maybe farm segment. And now we are coming into stationary engines. And all of the multinational companies on the stationary engines are putting up large capex for growth, which they see for the next 10 years, totally, on the stationary engines for backup generators. So I don't see any risk on the powertrain per se. And India is becoming slowly and quite a big hub going forward, because now there's no more investment happening from multinationals into China. So we will see growth happening on that front also for the global market. Yes, as we improve our revenue stream there, the operating leverage will be better. Margin should improve going forward. We hit the lowest level in this particular financial year. From next year onwards, it will look positive going forward. On the aluminum business, we have a segment which is now more predominantly on the passenger vehicles and also significantly high on the two-wheeler segment, which we have de-risked with also the structural parts of the alloy wheel. So overall, the capacities and capabilities are fungible. The casting process by itself, high pressure die casting, gravity die casting, low pressure die casting, they do not, the missions or the equipment or the people do not differentiate between what is the end application of these particular parts, whether ICE or non-ICE. We are more interested in gravity and low pressure going forward more and more, because we see, just like on the two-wheeler, the lightweighting has happened on the aluminum front. On the passenger vehicle, the aluminum content will go up, whether it's ICE or EV, both it will go up. So we see the capability of the castings point of view remaining the same. So these capacities are fungible with EV on the aluminum segment. I hope I have answered that thoroughly.
Yes, sir. Thank you very much.
Thank you. The next question is from the line of Saket Kapoor from Kapoor Company. Please go ahead. Saket Kapoor, please go ahead with your question. Your line is unmuted. As there is no response, we'll move to the next question, which is from the line of Dinesh Gandhi from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for follow-up opportunity. First is on the stationary engines, you indicated we are working with 5 of the top 10.
Mr. Gandhi, may we request you to speak on your handset mode?
Yeah, sorry, just give me a second. Yeah, better?
Yes, please go ahead.
Yeah, Ravi, you talked about you're working with 5 customers of the top 10 customers on the stationary engine side, and you have got orders as well. So any sense on the quantity of the order, quantum of the order which you have got for the stationary engines on that side?
I had mentioned that in FY29 we will be doing around 100 million on the casting and machining front. How it evolves in the in-between period depends on the time for the gestation for the approvals. So we are targeting 100 million by FY29, if not earlier.
So that's we already have orders for $100 million, or that's the aspiration?
So I cannot give strategic answers, Mr. Dinesh Gandhi, because there are many people interested in this call in detail, which customer, where we are and what we are on this matter.
I understand.
And you see, we acquired a company in Frauenburg, which is, I think, anyway in public domain, 200-300 crores. That is already there. I'm not counting that into the $100 million sort of business. So you know very well, when we are going to replicate at a higher capacity in India, the casting portion itself should be higher. And today, the growth in the market segment is 8-10%. I had made a public disclosure in my chairman's speech itself that this is going to be a growth area overall. And the projections of these customers, whether some of it is going to get organic, they are again making capex within. Most of the companies that are looking at outsourcing is possible, and not many outsourcing partners are there. So I think the size of the business what we are talking about is $100 million is very conservative, totally, considering the inquiries we have or the orders in hand or the orders are just which are about to finalize. I think this is, and this will be very sticky business as I mentioned.
Sure. And the second question on the stationary engine business for Kothavadi plant. We are expecting revenue potential of over 800 crores and our capex, if I remember it correctly, is 91 crores. So,
sorry, Mr. Gandhi, I think it is some big mistake what we are looking at. It is the combination of casting and machining together, which is $100 million, which I had mentioned. The machining capacity has been put up at our Hosur facility at Unit 3, which we started earlier. And to put the record straight, since you were asking a few more questions, we are getting castings all the way from North America. We are getting castings from Germany as we speak. It is being shipped to Craftsman, and we are machining samples. And next year we will be looking at export of castings, which we are importing from Europe and from North America, because even then our Kothavadi facility will not be up to speed to deliver that. So this means the customers are going to ship the castings to us, and we are going to machine it in India and send it back. So this is the nature of the business currently. It's a very exclusive club, so it is not easy to break through, and we have taken a big step towards breaking through into this segment of the business.
No, definitely it is. That's a very tricky business. And last question is on the storage business side. So we indicated automotive storage order book is full. But any sense on what percentage of our order book would be from automotive storage and what percentage of 3Q revenues came from automotive storage?
See, the Q3 revenues of the automated storage has come from orders which have received more than 1 year back because of the gestation period for automated storage. Because it requires a new land building site for the customer side, and not land, at least the building site, and also the execution time for such long gestation projects with this electrical, electronics, mechanical, software, and the integration with their ERP system, which is working. So we are having an storage revenue on the automated storage. Totally how much it was? It was for the year to date, it has been 142 crore for the automated storage.
142 crore for 9 months.
For the 9-month period.
Sure. Got it. This is very helpful. Thanks.
It has been around 260 crores. So 400 crore has been the revenue, and this year we'll be closing at around 500 crore, which is a big milestone overall, because we started practically on the revenue side post GST. We have been preparing from 2012 onwards. In the 5 years of up and running, we will be touching 500 crore revenue, and we are already in the top 3 bracket on the static racking. And among the Indian players on the automated racking, we are among the top 2 already. Totally.
Great. So thanks and all the best.
Thank you.
Thank you. The next question is from the line of Ajok Fredericks from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity. Sir, I have one question. From your guidance, the incremental revenue and EBITDA, where do you think will those be coming from? Kothavadi, Bhiwadi, Frauenburg, Sunbeam. So if you can give some broad sketches on the 7,000 crore and the 1,100 crore, the incremental is going to come through for next year.
So we look at the revenue for this quarter, which is an indication of where we are going. We are looking at a revenue of Q3 has been the number. What's the number exactly? The Q3 number. Q3 consolidated number.
1576.
Yeah, 1576. If you are looking at that into 4 itself, it is coming to around 6,000 crore. So we'll be much higher than this number in Q4 without any contribution from Hosur plant and negligible contribution from the Bhiwadi plant totally overall. And the So I think it is quite a conservative number what we have given. 1,576 into Q3 has been always a lower number because of the market situation. And if you multiply that into 4, it is 6,300 crore. So I had given a top line of 7,000 crore, which is quite conservative.
Okay. So you're saying incrementally, probably Kothavadi, that 150 crores you mentioned, that will come through. And then some Frauenberg and Sunbeam. So that's what incremental.
Yeah, Kothavadi may be 100 odd crore or 150 crore, but I think Bhiwadi will be quite significant in the next financial year, because we will be peaking at Q2 itself before the festive season, and the capacity will be done. Because we have set up the plant within 8-9 months. Normally the plant takes 18 months to set up. So we will be up to speed on that level. So we are looking at more than 300 crore revenue from Bhiwadi plant itself. And maybe 150 crore from the Hosur plant. So with that itself, we'll be home and dry on 7,000 crore. But I'm a little conservative in saying that a higher number than that.
Okay, sir. And on margins, I mean, EBITDA 850 to 1100, that run?
Yes, EBITDA we are looking at for the consolidated number anywhere between 1,000 to 1,100 crore on the console numbers.
Okay. Which will be driven primarily again your Bhiwadi and Kothavadi, the same revenue line related to mention.
I would say this year has been little because of the losses which we already have shown, because we have incurred one-time expenditure maybe for acquisitions, and also we had losses from Bhiwadi and some expenses in Kothavadi and totally, and we have geared up in Craftsman to manage Sunbeam also, and we are supporting Sunbeam for tools and dies and other technical operations, because not much of investment has gone into Sunbeam overall. Our engineering resources are working there for that matter, and it's all a combination of many things now.
Great, sir. Congrats and all the best once again for your strategic journey. Thank you.
Thank you, Ramesh.
Thank you. The next question is from the line of Abhishek Jain from Alpha Accurate Advisors Private Limited. Please go ahead.
Sir, in this quarter, we have seen a significant jump on the interest and depreciation cost. So, if you can give some color on the quarterly run rate of interest and depreciation in the from quarter 1 FY26.
I think it will be little not apple to apple, because we had in between raised equity, and then we had spent it for acquisitions. So, and then we started also greenfield investments. So we will not be able to exactly tell. I think this is the current the interest cost is around 9%, I would say. So, and the debt, we already mentioned the debt level. Depreciation currently is just a minute.
Depreciation is just 103 crores.
195 crores depreciation, yes.
Hello?
Yes, please.
Yes, sir. So depreciation is 104 crores in quarter 3rd. So what would be the run rate in Q1 FY26?
252 crore is the depreciation for the year to date, right? Totally this is not an apple to apple, because some of the subsidiaries have been only for this quarter. So this quarter depreciation all put together is how much? Okay. For console number? 103? 103? No, 103 is the number. So we are looking at around 400 crore depreciation for the next financial year.
400 crores, sir?
Yes, 400.
And sir, in a tax, because of the lot of the acquisition and the losses happened in these companies, can we assume that the effective tax rate will come down significantly because of this?
Only the Sunbeam there is some tax cover. Otherwise, there's no tax cover anywhere else. It's always been profitable, I would say, totally on this. And the overseas subsidiary is an slum sale. It is not a company which you have taken over. So the Tax benefits will maybe around 100 crore will accrue over to Sunbeam over a period of 2-3 years as and when they make profit.
So most probably the tax rate will come down to that 20 to 22% in FY26 because of the 100 crores kind of the benefit.
No, that is only the subsidiary. It will be on Sunbeam. It will not reflect on Craftsman's tax structure nor on DR Action tax structure.
Okay.
We have to pay the full normal corporate tax, 25%, is it? Yes.
Okay, sir. Thank you, sir. That's all from my side.
Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Ravi for closing comments.
Thank you very much for all of you to participate in this. And I want to make some important concluding remarks. This is the time to scale up when we are looking at import reduction. The government is also very serious about it to grow the Indian industry. We are also having a little slowdown in growth where our customers are not growing as we would like to. There has been a geopolitical situation. There is an opportunity where we can export a lot, or the multinationals are setting up shop in India. On top of it, we are also reaching an inflection point as a customer that understands as a company where we need to break through on new avenues for a growth trajectory. So for that, the company has to take up some amount of pain and a little amount of leverage for a short period of time. So only when we have capacity, only then the customers are interested to look at us. Otherwise, China's growth story has been always that capacity front and then orders follow. We are not being so aggressive there, but we have slightly been little ahead of capacity now for the first time, and we'll see the fruits of it in the coming years. Thank you very much for staying with us.
Thank you. On behalf of Craftsman Automation Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.